Welcome to our end of year financial planning YouTube series. I'm BizGirl, and this week we're going to look at bad debts. What is a bad debt? This is an amount that a customer will not pay and can happen whenever credit is extended to a customer. So if you invoice customers monthly and don't expect them to pay until the 20th or the end of the next month, sometimes this can create a bad debt if the customer cannot afford to pay. Warning signs. A sudden change in payment habits. This is a big warning sign, especially if you have a customer who always pays on time and is suddenly late. This means something could very seriously be wrong. So make sure you follow up on them and ensure that you set a deadline for them to pay by. The economy has slowed down. This can be a big warning sign, and especially due to COVID in the last few years, this could cause a lot of bad debts, as a lot of businesses may be closing down or become insolvent. Your customer admits cash flow problems. If you call up and they have an overdue account and they tell you that customers are really slow in paying them, possibly don't increase their credit limit, as it could just extend the amount that you're owed and you may not get paid for this. If your calls go unanswered and your customers suddenly become unreachable, this definitely means that they could be having money troubles and may not be able to pay your bills. So ensure you leave a voicemail or send follow-up emails. And if you cannot get any response, put this over to a debt collector. If your customers suddenly get new competitors entering the market could mean that their sales decrease and they can start having cash flow problems. Really, you just want to ensure that you're going to get paid, especially if you're supplying stock. If your customers start suddenly discounting or uncharacteristically slashing prices of their products or services, their sales may go up, but their margins will decline, and this can also result in cash flow problems. If your customer's business suddenly changes course, especially if they're a market leader in their sector, this can show that they're having issues and may be unable to pay. So just watch out for these signs, because you don't want to end up not being paid for your products or services that you've already supplied. When should bad debts be written off? You should look at those now, especially with it coming up to the end of financial year. In New Zealand, bad debts need to be written off in the year that they're assessed as being bad. So if you wish to claim the bad debt expense in this financial year, it needs to be done before the 31st of March. So you need to keep an eye on your accounts receivable and ensure any bad debts are written off before the end of the financial year. If you check these in, say, April, you shouldn't backdate them. They need to be written off when it's worked out that they are bad. So how to write off bad debt? We're going to show you an example of how to write off bad debt in Xero. So we're in the demo company in Xero, which you can see here. So to write off a bad debt, we'll go into businesses and into invoices, because we need to find the invoice that we've assessed as not being collectible. So we'll choose this Ridgeway University invoice right here. As you can see, technically from these dates this invoice isn't due yet, but we're just showing you an example of how to do this. So these bottom boxes down here, do not use this to write off bad debt, as this does not make an adjustment for GST. Because remember, if you've charged GST and you write something off as a bad debt, you're able to claim the GST back. So we'll go up to invoice options here, and we want to add a credit note. It pulls in today's date, being the date that you're writing this off. It'll automatically pull in the sales account because that's where it was previously coded to. However, we want to change this to bad debt. This allows us to be able to see it under the expense column, and it doesn't just reduce sales. And we'll just approve this now. So we'll head up to accounting, and we'll choose a profit and loss report. This way it will show that the bad debts has been written off. So you can see up here in February, the invoice amount will still be in here. However, reducing sales is the bad debt expense down here. This ensures that it shows separately and is more accurate. Thanks for watching this video in our end of financial year planning. You can find me at Instagram at AsBizGirlBlog or else on Facebook. If you want to know more about Xero, check out the links in the description box below.